Welcome to the program, ladies and gentlemen. Howdy, friends. Bright and early, although not as bright and early as we normally are, right? Because we picked up the extra hour last night. It's fallback, so it's supposed to be 10, but it's really 9 under the new timing. So make sure you adjust accordingly for that. Hopefully, with the extra hour, you're not running behind. Or maybe you're even running ahead. So that would be great. Speaking of running ahead, my goodness, the market is at an all-time high, breaking records this past week. We're going to talk a little bit on the program today about what you should do if maybe you've missed it. Maybe the past few years you've been sitting in cash, or maybe you didn't have any cash and now all of a sudden you do. And so you've got a real head scratcher as to what to do with that money with the markets being as high. So we'll talk about that on the program. And then we are rapidly into November. So that means that there's a couple of months left in the year. And so we wanted to talk this week on the program about some of the tax things that you want to consider going into the end of the year so that hopefully you can adjust your 2019 taxes a little bit perhaps more favorably than how those taxes last year came out. So we'll talk about all of that. Plus, of course, as we do each and every week, we'll take your calls at 407-916-5400 or toll-free 1-866-916-5400. And then, of course, if you'd like to send us an email, you can do that as well. That email is Joel, Joel, at nelsonfinancialplanning.com. Don't forget to also follow us on social media as well, because that's where we put up the video of this program as well, along with a little snippet of sort of what the teaser topics are. So check out all of that on places like Facebook and Twitter and even our website at nelsonfinancialplanning.com. So that's how you can follow along. And yes, a couple of months left in the year. If you recall last tax season, the 2018 return was the first one that had a whole lot of changes in it for quite some time. And those changes had some pretty significant ripple effects. Perhaps you remember some of the stories about how there were a lot of folks that were surprised at how much their refund went down. Well, the reality is that overall, refunds were about the same, but there was a particular category of people, those earning between $100,000 and $250,000. That's the income that they were reporting on their tax return. That group saw about an 11% decline in their refund. So that group of people, and there was about 13 million people in that category that experienced an 11% decline in their refund. So that was kind of the piece that was making a lot of the headlines, and rightfully so, because it affected 13 million people. The reality is that there was a change in terms of withholding. There was a change in terms of standard versus itemized. And the good news is that the IRS has, in fact, adjusted the withholding calculator online to better reflect the right amount of withholding that you should have on your paycheck under these new tax laws. So one of the things that you probably want to do, and there's still a couple of months left in the year to do it, is to double check what your withholding is. Make sure it is in line with what it should be. Now, it's a little late, but there's still a couple of months left in the year, so that if you're behind, then perhaps maybe you can catch up a little bit in terms of what the withholding is. So make sure to check that withholding, because they have adjusted the calculator and they have improved that calculator as well. Another 25 million found that they were no longer able to itemize their deductions. And so that was also a pretty significant shift over prior years. All those folks that would keep track of all their charitable receipts and keep track of their sales tax receipts and keep track of their medical expenses and keep track of all of those things, their unreimbursed employee expenses, all of those things that they would keep track of. 25 million people found that, yeah, good for you for keeping track of it, but it doesn't do you any good because of that jump in standard deduction. Well, for 2019, that standard deduction goes up a little bit even over where it was for 2018. 2018, married couples standard deduction was $24,000. For 2019, the standard deduction is going to be $24,400. If you're single, it's $12,200. So the standard deduction continues to sort of creep up a little bit on the overall tax return. So what that means is that you've got less and less people with the ability to itemize. Some estimates say that under the old rules, there was about 30% of returns that had itemized deductions. That 30% that dropped down to 10%. So obviously, that was a pretty significant issue in terms of the taxes and a significant change for sure. Now, what can you do to try and address that if you do charitable contributions and you are close to that new standard deduction? One of the things that you can do is look at perhaps grouping charitable contributions in one year, right? As we get to the end of the year, then the calendar rolls to the next year. One option that you've got is to try and pull some of those gifts that you might typically give in the first quarter of a new year to pull those into the fourth quarter of the prior year so that you could sort of double up what your charitable contributions were. And so consequently, that may be a way in which you can have a better result on your tax return because you will have pulled in a little bit more charitable contributions. So that's one of the things to be thinking about as we get to the end of the year to try and make sure that you're taking advantage of what you can as it relates to the taxes, because there's certainly been a whole lot of changes. Another item that is really a must, and I think most investment providers are pretty good at reminding people of this on a regular basis, and that is this notion of the required minimum distribution. Now, if you are still working and have a 401k at work, then you don't have to worry about that. But the reality is, though, that if you've got an IRA or an old 401k, then you've got to take a required distribution from that if you are over age 70 and a half. In the first year, the year in which you turn age 70 and a half, you get a one-time adjustment on that where you're able to kick that distribution into the next year, but it's got to be done by April 1. And that year, you wind up, in essence, doubling up the amount that you have to take out because you still have a required distribution that you would have to take out that year as well. So generally speaking, required minimum distribution, that's got to happen, and it has to happen between now and the end of the year, particularly if you've got old 401ks. You've got to take the right amount from each 401k. You are not allowed to aggregate and take money from just one or take money from another account when it comes to a 401k. Another reason in the list of reasons to roll over your 401k to an IRA, with an IRA, you get to aggregate that required minimum distribution and take that from whatever account that you want to. If you want to take it evenly across all the different accounts, that's fine. But if you've got one account that you want to specifically take from, then with an IRA, you're allowed to aggregate across different IRAs, but you're not allowed to do that on an old 401k when it comes to your required minimum distribution. So if you want some additional flexibility, let's say you've got an account that has some cash or has some position in there that you no longer want, you could use that to satisfy your required minimum distribution across all of your different IRAs, with the exception if that is still a 401k, then technically that required distribution on that 401k has got to come from that 401k. So a little bit of a nuance there in terms of how the required minimum distribution plays out. The reality is, of course, that if you are still working, you don't have to worry about the required minimum distribution on the 401k that you are currently contributing. So some nuances there in terms of the required minimum distribution. Bottom line, that's something you certainly want to check out, because if you don't, then the penalty is 50% of what you should have taken. So it's a pretty pricey miss if you don't take your required minimum distributions. That's why I think most institutions are pretty good at sending you reminders about your age and, hey, you've got to take a required distribution and those kinds of things. But not all of them are as consistent as getting that word out to you. So make sure that you take that required minimum distribution between now and year end. We've got some other things that we'll talk about on this topic as well, in terms of some of the things that you can do between now and the end of the year to help improve your 2019 taxes. But we also want to talk a little bit more about the markets and sort of what happened this past week with the market setting record highs, and ultimately what you can do if perhaps you've missed it. So we've got some interesting statistics on that for our next segment. So stay tuned through the break, and we will be back after these messages here on Dollars and Cents with your host, Joel Garris. That's me, of Nelson Financial Planning, on News Radio WFLA Orlando. Howdy, friends. Joel Garris of Nelson Financial Planning here. You're listening to Dollars and Cents. So the headlines this past week, the markets all were hitting record highs. Certainly there was a number of factors that went into that, ranging from another interest rate cut by the Federal Reserve, stronger employment data coming out this past week as well. And then, of course, it is earnings season, albeit earnings season is starting to sort of wind down a little bit. But so far, 75% of the companies that have reported their earnings for the third quarter of this year have beaten expectations. So anytime you get those types of positive surprises, along with solid employment economic data, then you wind up having a market that continues to go up. And so certainly you hear a lot about folks saying, well, my goodness, this market is so high, it's come so far, and I'm nervous about trying to invest after that increase has already happened. And I think that's a very normal concern that investors have. And there are certainly many investors that have been sitting on cash and sort of waiting, and perhaps have missed an opportunity or feel like they've really missed out, or perhaps there's an event that has happened and they find themselves with money for the first time. And so what ultimately do you do with it? And those are some tough questions to sort of tackle against the backdrop that is the markets, particularly the markets have done quite well over the course of the past 10 years. Coming out of that 2008 decline, the markets have really continued to progress very strongly over an extended period of time. And so the important thing to always remember when it comes to investing money is that it is time in as an investor, not timing. Okay, that's a pretty important concept that should be guiding your investment decisions. Time in, not timing. There was an interesting analysis done looking at two different investors over the course of the past 20 years. Investor A was very good on his timing, and he was able to invest on the best day each year for the past 20 years. And the best day each year in terms of investing would be sort of the market low for that year. And so every year he took $10,000, and he was so brilliant, lucky, that he managed to invest on the very best day to invest, which would have been the day when the market was low. In contrast, his buddy, Investor B, wasn't so lucky. He was the very definition of unlucky, and he invested his $10,000 every year on the worst day to invest, which would be when the market was highest for that year. And so the analysis looked at the comparing Investor A, who had perfect timing of whenever he invested money each and every year for the past 20 years, he picked the best day to invest, the market low for the year. Meanwhile, his buddy, Investor B, picked the absolute worst day when the market was high. And you would say, well, my goodness, there has to be a pretty significant gulf in terms of how Investor A did versus Investor B. And the interesting thing is when you run the numbers on it and carry it forward, the reality is that there isn't a whole lot of difference in terms of the overall rate of return. The one that had perfect timing had a return, an annualized return of about 9%, just looking at putting that money in at the perfect time, just looking at the overall markets. His return over a 20-year period of time was 9%. The one that had the worst possible timing, his return was about 7%. Now, okay, that 9 versus 7, no, I get it. That's a little bit of a difference, but that's not that much of a difference considering how skewed the analysis is. We literally have one person investing perfectly and one person investing at the worst possible time, and a couple percentage points between their overall rate of return over a 20-year period of time is not that big of a gulf. So if you follow the analysis, it really does underscore that at the end of the day, it is time in, not timing. Because when you're getting a 7% or a 9% return, you've got the ability to double money every 10 years. And so both Investor A and Investor B, despite their perfect timing versus imperfect timing, had a considerable return on their investment over that 20-year period of time. The most important thing is that they stayed consistent and continued to do it each and every year. And that ultimately highlights an important concept of what you should be doing now. If you're sitting there thinking to yourself, this market's so high, I don't really want to invest, or I've come into some money, I don't really know what to do with it, the market's high, what should I do? And we'll go back to that very simple example of the importance of being consistent and having time in and not timing. So much like that example goes through, the importance of putting money in on a regular basis. So one of the best strategies that we advocate to people that are waiting and waiting and waiting is that perhaps what you do is you put some money in on a regular basis. Don't make it an all or nothing decision on some random day in the calendar. Make it a systematic investment on a regular basis, because that really does help to smooth out the overall volatility of the market. That helps to build a consistent habit, a consistent behavior that ultimately produces the best possible investment result over time. Because let's face it, folks, that's how investment results are achieved over time. Not perfect timing, not imperfect timing, but just being consistent. So if you're sitting there waiting, scratching your head saying, my goodness, this market's at an all-time high, what should I do? What can I do? The answer is start to put some of that money in an investment on a regular basis so that ultimately you smooth out the volatility that is in the market. That's an inherent level of volatility. So start by just regularly putting money in to that investment. It's a concept called dollar cost averaging, and ultimately dollar cost averaging really does work to try and smooth out the volatility and really helps to give you an answer on what do I do if I've got a market that's high and I'm concerned about investing that money. If you're concerned about investing that money, the longer you sit, the longer you wait, the less return it's going to get anyway. So you have to break out of that mold of the waiting and waiting and waiting, and ultimately have a strategy that you can use. And that strategy is to dollar cost average and put that money in on a regular basis over the course of time. So take the next 6 months, 12 months, 18 months, whatever the case may be, but make sure it doesn't just continue to be this waiting proposition, because waiting will cost you money. It is time in the markets, not timing, and that ultimately allows you to achieve the best possible investment result over time. Sitting in cash isn't going to cut it. And the reality is, it doesn't matter whether you've got perfect timing or imperfect timing. It's important to have that time in. So certainly something to be thinking about if you're one of those folks out there that find themselves sitting on their hands for an extended period of time, or maybe they've just come into some money and now they're concerned about what to do. Have a strategy on it. The dollar cost average strategy really does work very well. So certainly something to think about in light of where the markets are today. We will be back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando. Welcome back to the program, ladies and gentlemen. Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio WFLA Orlando. Open lines in the studio this morning, 407-916-5400. Toll free, 1-866-916-5400. Or you can shoot us off an email. That email is joel@nelsonfinancialplanning.com. That's how you can get in touch with us during the program. Hopefully you all heard that last segment. Pretty interesting numbers when you look at an investor, two different investors that both invest $10,000 a year going back over the course of the past 20 years. One investor had perfect timing. The other had the worst possible timing. At the end of the day, both of them still had some pretty respectable returns. The one with perfect timing obviously did a little bit better at 9%. The one with the worst possible timing still at 7%. Last I checked, that's a whole lot better than what your cash is doing sitting in a money market or a CD or something like that. So if you have missed out, if you've sat on the sidelines, sat on your hands, or perhaps you've had an event happen whereby you find yourself with money for the first time, don't let the fact that the market is where it is at deter you from actually investing that money and doing something with it. The reality is that to achieve results over time, it requires time in, not timing. And The only way you're going to do that is to get started. Dollar cost averaging is a great way to tackle that. And that's the simple concept of putting money in on a regular, systematic basis. Don't leave it up to your emotions or your gut to do that. You want to systematically do it so that the money actually gets invested rather than winds up being excuse after excuse after excuse. So some important things to be thinking about, particularly in light of investing in an environment where the market has certainly been doing quite well of late. So hopefully those are some useful strategies for you. Speaking of some strategies, we were talking a little bit early in the program about some of the things that you can do for your taxes. Obviously, 2018 was a big change in taxes. There's still a couple of months left in the year, so it's not too late to make some adjustments if you didn't like the result on your 2018 return. Perhaps the biggest change was the movement over to a higher standard deduction. You wound up having about 25 million people out there that found that, hey, we can't itemize anymore. And so earlier in the program, we were talking about one of the strategies to perhaps sort of take advantage of that is to load those deductions or those expenses in a single year rather than straddle them across two. So let's say that you make a regular contribution to your church on a quarterly basis. You may want to take the first quarter of next year's contribution, slide it in at the very tail end of this fourth quarter, and then that way you're able to sort of double up that charitable contribution, and then that may very well help you get across the threshold for that standard deduction and allow you to continue to itemize. But certainly the standard deduction, relatively high number. It went up again for 2019 to $24,400 for a married couple. So much bigger number than what it has been in the past. One strategy, though, that you have to make sure you're doing between now and the end of the year, as we mentioned, was doing the required minimum distribution. A very effective strategy, speaking about charities and required minimum distributions, is to have that required minimum distribution go as a qualified charitable distribution, which means that you are directing your IRA to make a check payable to the charity, and that check goes directly from the IRA over to that charity. It's got to be done that way, because if it doesn't, if the money goes to you and then you write the check to charity, it doesn't count as a qualified charitable distribution. So that's one of the more powerful things to do to be able to help reduce your taxes without having to itemize. Those charitable contributions, typically you would have been able to itemize them, but now with the higher standard deduction, perhaps you're not. What's a way you can get some benefit? Well, if you have to take a required minimum distribution, make sure then that you take advantage of that qualified charitable distribution, because that certainly is a pretty significant opportunity for you to be able to get an advantage by making that charitable contribution. So make sure you've certainly still got time between now and the end of the year to be able to do that. Make sure that you take advantage of that, because that's a pretty powerful and a pretty important one. Some of the other things to be looking at between now and the end of the year is very simply capital gains and losses on an after-tax or non-retirement type of account. Let's say that the value has declined in that account. Perhaps you look at generating or converting that loss to an actual loss that you can realize on your tax return. Remember, a loss on paper is just that. It's not anything that you can use on your tax return until such time as you wind up converting or actually do a sale transaction on that in order to convert that paper loss to a realized loss. Another thing also to be aware of is that at the end of the year, of course, is when a lot of funds will distribute out dividends, will distribute out capital gains. Make sure that you're aware of what those numbers are. A lot of those funds have already put out an approximation or an estimation of what those capital gains are. It looks like from our perspective that capital gains are generally going to be down a little bit from where they were last year. They kind of spiked up last year a bit more than what they had, and but this year it looks like they'll be a little bit lower by about 10 or 15%, and so that will help on the taxes. But that's certainly something that you can check and verify, and you may even want to adjust your quarterly payment that's due in January in light of whatever those capital gains are. So certainly something to do between now and the end of the year so that you can make sure that you're not having as many tax surprises on the 2019 return as perhaps you may have in the past. So anyway, we will slide to a break. During the break, we've got open lines at 407-916-5400, toll free 1-866-916-5400. Those are the numbers to get in touch with us and join us on the program here at Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLAR. It's actually News Radio WFLA Orlando now. So anyway, there's the new and latest. We'll be back after this. Welcome back, ladies and gentlemen. Dollars and Cents here. This is Joel Garris of Nelson Financial Planning. Was thinking during the break a little bit about some of those things that you have to do between now and the end of the year in order to make sure that they're into this year's tax return. There's some other things, though, that you don't have to do right at the end of the year, but you can, in fact, let it roll into next year as long as you do it before April 15th. Things like funding an IRA, things like funding an HSA, those types of things are about the only thing that you can still do and affect the current year taxes, even though you're in a new tax year. So understand, though, that there are some things that you can do once the calendar turns to 2020. Hard to believe it's going to be 2020 next year. And that is then something that you can do to try and offset or reduce your taxes. So oftentimes, funding an IRA, funding a Roth, funding an HSA, you actually do have the extra 3.5 months until April 15th in order to be able to do that. Still, other types of retirement accounts like a SEP IRA, if you're self-employed, those you can actually go all the way out until the tax filing deadline, and which, depending upon how many extensions you get, can be as late as October 15th. So certainly some options after the calendar turns into the new year that you can still generate some savings on your tax return. So important to kind of keep that in mind as well, is that you do have some time on that, but certainly the strategies involving required minimum distributions, qualified charitable distributions, capital gains losses, changing your withholdings, trying to load up your deductions in this year versus splitting in between 2 years. Those are the kinds of things that you've really got to do between now and the end of the year in order to have them count for this year. So certainly some important stuff there. Other statistics that we saw this past week that caught our eye. I know on a prior program we talked about kind of the wealth tax. It appears, though, that when you actually look at the numbers based upon some of the studies out there, that the subsequent generations do a pretty good job at sort of a reverse wealth tax, in that they wind up spending the money, and it usually doesn't last more than a couple of generations. Here's the numbers. There was a study involving 2,500 wealthy families over decades of wealth transfers across generations. on average, okay, only 30% of the only 30% of the original family fortune remained at the end of the second generation, and only 10% of the family fortune remained at the end of the third generation. So there appears to be some kind of a wealth tax at play anyway, based upon families and generations, and how sometimes those subsequent generations can really mess it up. I think that's probably an advertisement for having some type of a trust. If you're concerned about how that next generation might spend it, having some type of a document like a trust that says, hey, you don't get to spend all of this freely. It's going to be distributed out to you over time. It's going to be distributed out to you as income. Those are some important concepts that would certainly go hand in hand with some of these studies of how little money actually lasts when it goes from one generation to the next. And then that third generation is usually not a whole lot left over. So be aware that one of the things that you can do for that is to set up some kind of a trust. Now, I think often trusts are perhaps one of the more ubiquitous things out there that aren't necessary, particularly if your kids are all in good shape and you trust them. But if you're concerned about wealth and making sure that it passes from one generation to the next, certainly a trust is a good vehicle to be able to do that. If you're just simply leaving your assets to your kids outright, then that can easily be accomplished with just naming them as beneficiaries on any and all accounts. But if you want to have some level of restriction, some level of control over it, then that's where a trust would come into play. And that trust then is the document that determines how that money is going to get distributed out to the next generation over time. And certainly when you hear statistics like this, you think to yourself, well, maybe that's not a bad idea. Because certainly there's a tendency of subsequent generations to not do a particularly make strong choices in terms of how that wealth ultimately gets used. So certainly some interesting numbers on that. Another interesting thing we saw this past week was a proposal in Washington that would actually extend the availability of Medicare to retired firefighters, police, and EMS. And what's interesting about that is that group of folks typically retires at younger ages because, let's face it, it gets a little bit harder chasing down the bad guys and running into burning buildings as you get older. That's just a reality of the body and the body aging. And so many of those folks retire early, and sadly, many of those folks, the average life expectancy isn't as good as it is for the people as a whole. And so one of the proposals that's actually up in Washington right now is to give that group of folks an opportunity to apply for Medicare, not at the usual age of 65, because see what happens is those folks typically retire at earlier ages, and then the cost of health insurance and how they pay for that becomes a big issue. And so consequently, there's some legislation in Washington that would shift that to allow firefighters and police and the like to actually claim Medicare at the age of 50. So it's a very new proposal. It's on the table in Washington. I don't know that we'll see much progress on it, simply because, well, there's an election coming up in a year from now. And so consequently, I think that will be tabled until then. But what's interesting is that the folks in Washington are, in fact, sort of talking about this and at least thinking about it. And I think that's a good first step for sure, because when you have a group of individuals like our hardworking police, our hardworking firefighters, they do, from the physicality of the job, they do retire at earlier ages, and the need to get health insurance is still there, and then probably quite great for that group. And so consequently, being able to have an available additional option is certainly a interesting turn of events that's coming out of Washington. So stay tuned for that. We will obviously keep you posted on that as it develops. I don't know that will go anywhere, but it's great to see that at least on the table in terms of conversation, because that group is a tough group to not have health insurance. You certainly would not want that. So some interesting proposals out of Washington that are floating around. I'm sure we'll hear a lot more about this health insurance stuff over the course of the next year or so. We suspect it's going to be a major issue in the presidential campaign, of course, as a lot of folks continue to struggle with what the cost of that health care is. So we'll see how that progresses over the course of the next few months and years ahead. Certainly, they've got to figure out some kind of an answer and a solution up there. So anyway, hopefully you enjoyed the program. If you want to hear any more of it, or hear it again, or maybe you missed a segment of the program, as you know, we posted up on the various social media networks tomorrow, and so that'll be there, and then you can check in and review whatever you missed. So thanks for listening on in. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning, here on News Radio WFLA Orlando.